Hello, in this video I use the stock screener to arrive at the basic list of stocks of interest to value investors. Value investing is a strategy that focuses greatly on the key figures of companies. Using those figures, the market price is compared to the actual value of the company as determined by the investor. If that market price is lower than the real or intrinsic value of the company, then the company is considered undervalued and is worth buying for the value investor. A more in-depth introduction article on what value investing actually is can be read in our documentation section, and I'll put a link in the description below. My name is Christoph. Welcome to ChartMill. All filters used in this video can be found under the Fundamental tab on the stock screener page. And when setting the filters, it is important not to be too strict at the start so that we can get a wide enough selection. First and foremost, I select the dividend yield. Companies that structurally pay dividends will generally be considered to be on a more stable growth path. In addition to the stock price gain, you also get passive income from these companies, and this should certainly not be underestimated when it comes down to creating added value. I primarily select companies that pay a minimum dividend of 1%. The amount of dividend is less important in the first selection. I mainly screen for the presence of dividend. Later, this dividend component can be examined in more detail, for example by comparing the height of the dividend or the period over which the company has already paid out uninterrupted dividends. To what extent is a company able to pay its short-term financial obligations that are due within 1 year, the current liabilities? To find out, the current ratio is used. This is the ratio of current assets to current liabilities, and as a rule, the higher the number, the better. A current ratio lower than 1 means the company has more short-term debt than inventory or cash, and we want to avoid that. A current ratio above 1.5 is considered healthy, and often a current ratio of 2 is advised for value investors. But as we already mentioned in the intro, we want to obtain a first broad basic list with the filters. So as a basic filter, I use a current ratio of more than 1.6. The fact that companies finance themselves and take on debt should not in itself be considered a negative. But as a value investor, we do screen companies for that level of debt. After all, too much debt constitutes a risk in more volatile times if a company can no longer meet its obligations. We therefore look for companies with relatively low debt because, as a rule, they are more stable and more sustainable. We use the debt to equity filter and set it to a maximum of 1.4. When interpreting the results, you must however take into account that the debt ratio varies from one sector to another. Some sectors, such as the construction industry, are much more capital intensive than other, more service-oriented sectors. Keep this in mind when comparing companies that belong to a different sector. Earnings per share growth over several years is another indicator to select companies that are doing well. If profits can be increased over several years, it is a good indication that it is a safe company, which reduces your risk. I define that EPS growth over the past 5 years should be at least 5%, and I use the same percentage as an outlook for the next year. The trick in value investing is to buy good companies at a price that is lower than their true value. A value investor is a real bargain hunter. The price to earnings ratio is the ratio of earnings per share to the company's current stock price. And the lower the price to earnings, the more likely it is that the company in question is undervalued. Keep in mind though that price to earnings ratios vary widely by sector or industry, so companies should only be compared within the same sector. Furthermore, you should never look at this ratio purely in isolation, but always together with other parameters. A low price to earnings ratio does not automatically mean a company is cheap from a value perspective. It can also mean that the company is doing worse and is struggling financially. I use a maximum price to earnings ratio of 17 as a starting value. The price-book ratio is another valuation ratio that provides an indication of the underlying value of a company. Investing in stocks that sell near or below their book value makes sense from a value investing perspective. Book value represents how much a company is worth based on its own finances. For companies, this amounts to the total value of fixed assets minus liabilities. It is just like the price-earnings ratio, a valuation ratio that gives an indication of the underlying value of a company. and traditionally a book value of less than 1 is defined as very interesting for value investors. However, book value by itself is not a definitive measure of value. This is because book value does not provide a good indication of the value of intangible assets, such as intellectual property rights. Companies that develop software, for example, may be able to develop products at relatively low cost, and as a result, the balance sheet may not reflect the true value of the assets. Thus, a company's shares may be trading well above their book value, yet should not be considered overvalued. The book value should therefore be used as a comparator between companies. So we will add this value in the results table so that companies can be compared to each other on this ratio, but to be used as a basic filter, it is too specific. By using the above filters, you already obtain a fairly thinned out basic selection of stocks which you can further investigate. In order to be able to compare the companies properly, it's best to create a custom table that shows the selected filters and their values, like the one you see in this video right now. So this is how you do it. In this blue bar next to View, click on the inverted triangle. Scroll down and select Create Custom View. In the next screen, click on Table View. From the General menu, you select Ticker, Name, Sector and finally Price. Now select the Fundamental Dividend menu and select the option Dividend Yield. Next, go to the Fundamental Health menu and select the current ratio. Next, scroll down and select the debt equity as well. Now go to the Fundamental Growth menu, and from this section select the EPS 5 years and the EPS next year. Then to the Fundamental Valuation menu, where you select the price earnings. Also select the PEG ratio here. This is a modified version of the price earnings ratio, but also takes into account the earnings growth. This is especially interesting to compare companies that have more or less the same price-earnings ratio. And by adding the PEG ratio in the table, you get an even more complete picture because it provides a forward-looking perspective. Finally, in the same menu, select the price-book ratio we just discussed, which is displayed to compare its value for companies within the same sectors. Choose a name and press Save View. The table will now be available in the View menu. All columns where an arrow appears next to the name where you hover over it can be arranged from high to low or vice versa. For example, if I click on debt equity, then I first get to see all the companies with the highest debt to equity rating. If I click again, then the column starts with the lowest figure. In the table you cannot filter by sectors. Fortunately, this can be done through the main menu. Go to the General tab and under Sector choose the desired sector. For example, if I choose Materials, I only get the companies from this sector and I can then compare these companies with each other. As you can see, there are now American, European and Canadian companies among them. If I only want to see European companies, then I can set the exchange to Europe only via the same General menu. And the result list will then adjust itself immediately. So this is the Canadian list and this is then the US list. You can set many other things in the same menu, such as minimum price, minimum average volume, market capitalization and much more. The companies you ultimately want to hold back can be added to a watch list by clicking on the plus sign and adding the stock to an existing watch list, or you can create a new watch list. If this happens to be one of the first videos you see and you're still not quite familiar how to save screens or create watch lists, be sure to check out our ChartMill Academy playlist, of which a link appears right now and where you'll quickly learn the basic functionalities in ChartMill. So this brings us to the end of yet another video. If you liked the video, be sure to give it a thumbs up and become a subscriber to this channel to be notified of new content. In that case, don't forget to click the notification bell. Thanks for watching. See you next time.